Certainly, like traditional mixed asset funds, global mixed asset funds would provide investors the benefit of diversification. Global mixed asset funds are highly recommended for investors who are looking for a component that gives less volatility but still deliver the long-term returns that is higher than inflation and grow at a decent rate. In fact, our team has just released an insights piece on how a balanced portfolio, which is typically 50 to 70% equities and remainder in bonds, can deliver returns that are not too hot and not too cold, and with not too much volatility. Despite this strategy coming under great scrutiny in 2022, we do argue that it is still too early to call for the demise of the mixed asset or balanced portfolio. Data from 1990s shows that the ending value of the portfolio that is fully invested in the equities is close to 10 times its initial value, while the ending value of the all bonds portfolio has increased about 5-fold. The value of the balanced 60-40 portfolio sits in between at almost 9 times its initial investment. The key here is time horizon. While there have been episodes in history where both equities and bonds sold off, our analysis shows that mixed asset portfolio has significantly higher probability of beating a market timing strategy over the long term. This way, investors could achieve a Goldilocks portfolio that is just right in meeting their risk and returns profile without the volatility of a 100% equities portfolio, which could be too hot. Monitoring is on a constant basis. However, in general, rebalancing would take place at least monthly and as and when needed due to the changes in market conditions. When we rebalance the portfolio for a mixed asset fund of funds, for instance, we would form tactical views on overweight or underweight the equity relative to bonds based on valuation as well as technical and fundamental indicators relevant to the asset pairs. We consider things like equity valuation versus bonds, how has the price of these assets moved over the short and medium term, what does the latest macroeconomic indicators mean for each asset class, and ultimately, what does this mean for the future returns and relative performance of these two asset classes? Multi-asset investment solutions have become increasingly popular for investors focusing on efficient harvesting of risk premium across and within asset classes. As such, good global multi-asset portfolio may combine the power of equity, fixed income, real estate, or gold to create a portfolio that captures the upside and protects the downside. On top of offering exposures across asset classes, a good global mixed asset portfolio should have the sufficient flexibility to allow the fund manager to dynamically allocate across different investment styles, sector, geographies, or team within each asset class. Such flexibility will offer investors the protection needed in times of extreme negative volatility, as well as the opportunity to capture the returns when market conditions or stars are aligned. Just like sailing, one would first assess the boat position relative to the wind direction. However, the flexibility to set the sails and position one's body, weight, will ultimately determine the speed, the direction, and success in reaching one's destination through calm and rough waters. The key lies in having the different type of sails or asset and the flexibility to move them up, down, or sideways.